Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we have Jeremy Bendyke from Avoca Investment Management and Jeff Wilson from Wilson Asset Management. Welcome, gentlemen. Today we're doing a thematic show. In the last year, about 50 IPOs have come to the Australian market, and some have succeeded and some haven't, and we've finished it off with, in more recent times, the big Medibank listing. Jeremy, do you think we've run dry on IPOs?
Well, in the IPO cycle, you normally see some successful IPOs coming on in the early part of the cycle. It starts to build momentum. You start to see just towards the end, and as markets are topping out, which they're doing at the moment, the less successful IPOs. So that leaves a bit of a sour taste in people's mouths. And so with that risk on the table, I think we're going to see also going to Christmas a hiatus for at least another 3 or 4 months, and then people will come back post-reporting season and assess whether or not there's an opportune time to relist again. But
and what about price? Have they been priced too high?
I think there's been a general distaste, especially amongst institutional investors, and Medibank's probably the prime example about how we've been used to price that float. So I think until there's a bit more realistic expectations, you're going to see a little less enthusiasm.
Jeff, they're expensive, but the market keeps buying them.
I know you say that, but the last 2 that have come on, and I think the 3 that are due to come on, have all been repriced. And even the one that was on came on yesterday was repriced and came on at a discount. The interesting thing is, to me, it reminds me very much, and we're just talking about the end of that cycle. Is in before the GFC, we had Storm coming around to try to look to raise money to float. And we saw, in terms of the quality declining significantly, we saw a company, it was sort of mortgage, it was in the mortgage game and taking significant fees, and they came to see us in the last couple of weeks, and I'm just thinking, oh, this is definitely, the quality has declined significantly.
Quality's starting to decline, but the private equity guys who have been selling into the market, the market's the only real buyer at these prices. Yeah. They're going to keep coming though, aren't they? Oh,
of course, they'll try, and then it comes back to price, and it's really, the battle is that let's hope that after the Christmas break, we get some good quality companies, not just excuses for companies being priced realistically, and that's what I hope.
Jeremy, you said you saw the market topping. If we have a soft market in the first half of next year, do the IPOs go away? I think altogether.
I think pretty much you'll see a drying up of that market, because the appetite in a market which is struggling significantly declines, and the price that the sellers can get just goes below what they are hoping to achieve. So they wait for windows. They're very clever. If you ask a private equity guy, they're the smartest guys in the room, and they will wait and they'll get you.
And how does the buyer win and get lower prices? Because they haven't to date.
The buyer wins and gets lower prices by being diligent, by working. I mean, pre-IPO is one option to get in there and try to be involved in a Vita-like arrangement, Cornerstone, but it's pretty difficult. A hot IPO, you get a small allocation, you buy on one day, the first day VWAP, your alpha opportunity is really struggling.
Have you got faith in the market, Jeff, that they will work the prices down? The buyers haven't to date.
I've got faith in the market drying up for IPOs, and I think that's where we are.
So we've seen the best of the IPOs.
Yeah.
Do you agree with that, Jeremy?
Yeah, definitely.
Recent IPOs, some good ones and not so good ones. Jeff, we'll kick off with you.
Yes.
The big one, Medibank.
Okay.
Do you like it?
We own shares in it. We'll probably sell our shares in the next month or so. On the way we value companies, it doesn't look cheap.
Big company, good market share, but 20 odd times earnings, too expensive?
Oh, I think it's almost 23 times earnings yesterday, and on every pricing metric that we look at, we looked at 450 global comps for insurance companies, price to book, ROE, growth. It was expensive, and you've got to hand it to the government. They've done a great job for taxpayers.
Turning to aged care, Estia, it's been a small disaster on listing.
Well, these retirement villages or aged care villages are pretty interesting businesses. Nobody really wants to pay. And they're old people, they're vulnerable, so it's hard to make money out of them. Then you've got essentially a property play left if you're not making money out of the people that are your clients. So there's a lot of leverage involved in that property. So really you're looking at it as a leverage play on the property market, as opposed to a great business in a truly good operating sense.
So a sell?
It's a tough one. It's a tough
hold.
Yeah.
Okay, Jeff, it's down 20% from listing.
But I'm on sell. I know it's it's a failed IPO. It was expensive on listing, big multiple. They floated on 21 times, and like as Jeremy was saying, if we cast our mind back 10 years or so, that whole space, it struggled to perform as listed entities.
Okay, so it's a sell.
Yeah.
Let's get on to another part of the healthcare market.
Yes.
Dentistry, Pacific Smiles.
Dentistry.
It's come on well.
Yeah, it has done well. It has done well. If you want to play that part of the market, I think 1,300 is cheaper on a fundamental basis. So I'd say, well, hold or sell.
It's an $8.7 billion market, the dental market. So there's a lot of growth. What do you think at 20 odd times?
It is an expensive stock. We like the idea of investing in dental roll-ups, and well, this one's not a dental roll-up, it's a dental organic expansion story, because dentists are unlike other specialties, the dentists themselves are not expensive, and they're not problematic to manage.
So a good arbitrage.
So there's a good arbitrage there, and we're also interested in the fact that it's not completely funded by government. So you pay for it, it's a grudge purchase, you have to buy it because you've got sore teeth.
So we called it a soft buy?
I think it's a soft buy for us.
Okay. Now let's go to building and that lovely topic of education at the moment. Simmons?
Yep, Simmons.
Been a poor IPO.
Been a poor IPO. I mean, you go through its prospectus, it's floating at a point in time where its core market, Victoria, is turning down with small growth forecast relative to the last 3 years, and an opportunistic exit from long-term founders. Sell.
Jeff?
Yeah, I'm on a hold sell. The only thing that may hold it up is the fact that interest rates are going to go lower, and so the thematic might hold it up.
Around housing?
Yeah.
Okay, so we've got a mixed bag there. Some good, some bad. Thank you.